Welcome back, my awesome accounting students. Let's finish up chapter 24.
So we're going to have a short recap of the last class. We may do one or two exercises just to practice remembering what we talked about last time. Last time, our focus was on the non-present value methods, which means there is no credence or credit given for the time value of money. So our focus was what capital budgeting analysis is, what the major steps in it, why it can be more risky. We learned two methods. We learned the cash payback and we learned the accounting rate of return. The cash payback method answered the question, how quickly can we get our cash back? The shorter the time frame, the better, because once we recoup our cash, we can use it for other purposes. And then we talked about the one and only method that looks at GAAP net income. It's not concerned with cash, but it's concerned about GAAP net income. And that was the accounting rate of return. That resulted in getting a percentage return, and the higher, the better. Today, what we're going to focus on are the two methods that do consider the time value of money. And I think anytime you're looking at a medium to long-term project, anywhere from 3 years to probably 10 and more years, it's very important to look at the time value of money because money does have value to it. And if I'm able to set that money aside or to invest it in something else, I can generate a return. So we'll be talking about that today. We're going to schedule them back into today's dollars and we'll compare it to the cost. If we get a positive net present value, it's going to be considered a good investment, meaning that we're earning above our hurdle rate or our discount rate. There's a lot of terms that'll be used. We'll talk about that. And then the last method that we're going to talk about used to be very extensive, involving calculus and interpolation techniques. Thankfully, today, most of us have desktop programs like Excel where we can quickly and easily calculate the internal rate of return. It is also cash-based. The thing that it has going for it is that it will give you an exact rate of return. And so projects can be ranked just based on the internal rate of return that it provides. We won't be using calculus interpolation techniques, mostly because that was not a prerequisite of the course. Instead, we'll take a look at how Excel can return that to you within seconds, you'll see. And then again, as always, we'll spend the vast majority of our time today practicing. And of course, you guys are always able and I hope willing to ask questions. So that's where we're headed. I think we'll take a look at a few PowerPoint slides to help us recap and to get us back into the mindset of looking at the time value of money today. Does anybody have any questions? And so this is also a slide we looked at last time, just to remind us why this chapter is so important and why you'll have an upper level financing class devoted to this topic, or part of it will be devoted to this project. Because unlike a short-term decision, like what computer should I buy? If I buy the wrong computer, I'm out $1,000, couple $1,000, I'll recover. But if I'm looking at a situation, for example, whether to expand a product line or whether to take on a whole new product line or whether to expand to Mexico, these are things that I've helped other companies with, then that's not easily reversible. So the outcome is uncertain. You're usually talking about large dollars and usually very long time periods. Also, there may be long-term financial commitments. And once you start building a plant in Mexico, for example, it's kind of hard to undo that decision. So that's why we need to pay particular attention and make sure that all of our ducks are in a row. The life cycle, like we talked about in many other chapters, you have to usually acquire the investment, and sometimes it's purchased, sometimes it's built. You need to talk about how to use it and what it's going to cost to keep that resource going. And then many of these have disposal or salvage value or exit plans where money can come back in toward the end of the life. That's what we're talking about. So then a very quick review. These should look familiar to you. We talked about a payback period. We said when things are nice and neat, we can use this shortcut formula, but that usually doesn't happen in real life. If it did happen and you had equal annual cash flows, the simple formula is to put the cost on the top, the net, remember this is cash flow, and I want you to get that into your notes. 3 out of the 4 methods involve cash flow. Only the one, the accounting rate of return, involves net income. So we're going to have to be really careful on our test that we read the question carefully. And when I take a test, usually it's on paper, except in COVID circumstances, of course. But if I were in a classroom, I'd bring in my highlighter and I'd be highlighting, okay, what method is this? And do I need net income or do I need cash? And then I would be looking for the curveballs thrown in. Payback period usually isn't so nice and neat. If it were, this would be an example of how to calculate the cash payback. But in the lecture last time, we learned that many times the cash flows are not equal. And so we scheduled them back until we had recouped our cost. And we found that the payback period was where we hit 0. So evaluating the payback period, shorter is better. I also want to make sure you guys take a look at the last page of the handout for this chapter. Make sure you know the advantages and disadvantages of each. And as you heard me emphasize last time, the biggest drawback on the cash payback period is that it completely ignores all cash flows after that cutoff period. So you can have hundreds of thousands of dollars coming in maybe in year 4 if your cutoff period was 3 years, and that method completely negates those cash flows coming in. The accounting rate of return, we said the plus was that it does focus on net income, and net income is important to shareholders and to top management. And so it was the only method out of the 3 that did consider net income. And you'll be using this formula also on the writing project. So because the writing project's coming up, I want to make sure that this top number, you understand that it is annual. And so if you have different net incomes, which typically happens with most businesses, I don't think I've ever worked at a business where the net income was the exact same year to year. If you get different net incomes, calculate the average annual after-tax net income, right? So you'll see that on the writing project. I'm hoping that some of you have glanced at that. It's not going to be a nice, neat, even package where the cash flows are even. And so if you have 4 years of data, you would add up those 4 years of net income and divide by 4. Or if you had 10 years, you'd add up the 10 years of net income and divide by 10. So that accounting rate of return, make sure on the writing project that if the cash flows, actually it's the net income, if the net income is not equal, then annualize it or get an average is what I'm trying to tell you on that one. Good things, again, focuses on net income, which is important. Here's the author's perception of the weaknesses. Okay, we know it ignores the time value of money. The first 2 methods did. It's odd that he calls this a weakness. I call it a strength, but he calls this a weakness. He thinks the cash flows are more important. I think your shareholders would heartily disagree. And then if income varies each year, you may have the problem of it appearing desirable in some years and not others. There's actually ways to fix that you'll learn about in your upper level finance classes. So our focus for today are these 2 time value based methods that do consider the time value of money. The one we're going to look at today, and we'll go back and finish our last problem from last time to introduce this, is the net present value method. And this does apply the time value concept of money. And the goal on this one is if the cash flows in today's dollars, and that's where the difference comes in. We're looking at the cash flows in today's dollars. If those benefits are greater than the cost, you're going to see today that will give you a positive net present value. And if we get a positive net present value, that means that we consider this a good investment. And so the pink box kind of gives you our approach. We're going to discount the future net cash flows to today. And then we're going to subtract the cost of the investment today. And if that amount is greater than zero, it's sometimes called a hurdle rate, discount rate, internal capital rate. There's lots of words for it. If our net present value is above zero, that means it's a good investment. The downfall to this method is that it is more complicated. You have to have a knowledge of what the time value of money is. Oftentimes it requires either a financial calculator or the use of tables, which we'll be using tables today. And because it's more complicated, it is usually used as a secondary valuation, meaning that if all these proposals come in, I remember Cerritos recently had like 60 proposals come in when somebody said, hey, we have $1 million of grant money available. All of a sudden the proposals came flooding in. So they had to find a way to screen them. So in our examples, we may use cash payback and the accounting rate of return to set minimum parameters. And then if it passes the screening criteria, like you're going to see in your writing project, then we'll subject it to these net present value methods because it does take more time and it is a little bit more complicated. So that's an overview of what we're going to be looking at on the net present value. I think the next slide will further demonstrate it. Yeah, this doesn't happen too often. This is an example where the net cash flows are identical. Okay, so you'll see in this example that $4,100 is the annual net cash flow. So if I were to schedule this out, it'd be $4,100 in year one, $4,100 in year two. And then what's going to happen is they're going to apply these present value factors. Now, I started to talk about the concept of a present value last time. I think it's worth our time to talk about how those numbers are derived. I know we have tables and you're going to have access to the tables for the final exam, but because I do care a lot about retirement planning and because I think that a present value concept is something we should really all understand, I'm going to take a second and I'm going to get that Word document up here. And last time I was here, we talked about this timeline where we were used to looking forward. In other words, we used the concept that if I put $100 in today and someone asked me, what would that be 3 years from now? We'll call that N equals 3 years. As long as we knew what the interest rate was, we could go forward. We could do that on our calculators really easy, go out 3 years, and we could answer the question, what would that $100 be worth 3 years from now? And we demonstrated this last time, but just to kind of refresh our memory, after year one, if I did that on my calculator, it's 1 plus the interest rate. I would get 110. And if I did that out another year to 2 years, I would take 110 times 1.10. Do it with me. I don't want you to take my word for it. And I would get 121. Okay, so first year it was 110. Second year it was 121. The third year you would take that 121 now and multiply it by 1.10. And our investment would be worth about $133.10. That's called future value. That's taking a number that's known today and asking yourself, what is it going to be worth in the future? Okay, any concepts on that, just that general example of future value? Because present value is going to do exactly the opposite. Present value takes the same facts and it says, if I was willing to give you $100 3 years from now, 1, 2, 3, how much would you be willing to spend today for that investment? I want you to notice where the question marks are. That's where it gets its name, present value. They're asking you, what is that worth today in the present? Well, the opposite of multiplying like we did here is dividing. So to get that answer, we could divide 3 times and get our answer, or we can use tables. I'm going to do it both ways so that you guys have an idea of how that's generated. So to go back to this first year, instead of multiplying by 110, I would divide. So I'm going to do 100 divided by 1.10. And I'm going to get $90.90 is what that would be worth at the end of the second year. I'm going to take that back another year by taking $90.10 and dividing by 1.10 again. And I got 81.91 if I round. You guys can do that with me on your calculator. And if I take that 81.91 one more year back, divided by 1.10, and again, there's going to be a little bit of rounding, but nothing that I think is going to throw us off, I'll get 74.46. Okay, take a look at that number, 74.46. And what I want us to look at, and I hope I did that wrong, there's going to be a little bit of rounding. I'm going to try it one more time. This time I'm not going to round. Give me 1 second. I got 75.13 if I don't round. That might be a better number.
Yeah, I was going to say that 74 is a little bit off.
Yeah, a little bit off. Let's do the 75.13. So do that 3 times on your calculator real quick, just in front of me. 100 divided by 110 equals, don't get rid of that number, divided by 110 equals, don't get rid of that number, divided by 110 equals. Okay, I got 75.13. Hopefully you guys do also. What that means is that $100, I would be willing to pay $75 or less for that investment. That's going to give me $100 at the end of 3 years. Okay, now, if we're talking about a 10-year project, we don't want to be sitting there dividing by 1.10 for 10 different times. So we have these tables, and I gave you guys the tables in the handouts link. Let me show you what a table looks like. So I did open it. Here's the table, and the present value of an annuity is there, and the regular present value is there. For most purposes, we're going to be using the regular present value table. I want you to go down to the 10%. Let me make this bigger. The 10% column, and go down to 3 years. And here's this factor. You'll notice that it looks familiar. It's 0.7513. So any number you can take, and if it has a 10% hurdle rate for 3 periods, you would multiply that number by that factor and get the exact same thing that we got by doing a series of divisions. That's what this present value table is made for. So I asked you guys this what if question, and I used my own example. Let's say that I had a grandchild born today, and let's say that I can get 10% normal rate of return on my investments. If I want to have $100,000 sitting in that account by the time the child turned 18, I could take this present value table, go down the 10% line until I hit year 18. Okay, so I'm going right here. You guys have your own tables, but you can look at mine. I get 1.1799. 0.1799. 0.1799. And if I want to have $100,000 in that account by the time that child reaches age 18, I could put in to an investment account $17,990 today, not touch it again, and that would accumulate to $100,000 by the time that child was ready to enter college. That's the power of compound investing. After a while, if you consistently do it, even your interest is earning interest. And so that's why I wanted to take the time, even though we don't necessarily have to understand the whys. That's why I wanted to take the time to explain to you what the concept of a present value is. so that we can be looking for retirement options. The whole goal of this, you're asking yourself this question on the net present value. Are the benefits that I'm going to be receiving in the future worth the money that I'm paying for that investment today? So if my answer, am I willing to invest $17,990 today so that that child can go to college for $100,000 when he or she turns 18 years old? That would be an example of a present value analysis. So what we're going to be doing is we're going to schedule out the cash inflows just like we did here, and we're going to put them back into today's dollars. And if the value of those investments in today's dollars is greater than the cost of that investment, the net present value would be above zero, and we would say that that is a good investment. That's what we're going to be doing today. Any questions on the concept or the theory behind that before we jump in and try one? Okay, make sure you guys have those tables handy. If you haven't found them yet, go into the handouts link for chapter 24 and look for those tables, because we're going to be referring to them a lot today. And you will have those tables at your fingertips on the test.
Let's go finish up the problem that we started in the last lecture so we can demonstrate how this net present value method works. As you will recall, last time we were here, we used two non-present value methods. We took a look at calculating the net income. We converted the net income into cash. And then this third step, we left the video without completing it because it was necessary to talk about the concept of the time value of money and specifically present value. So requirement number 3 asked us to compute the net present value for this machine using a discount rate of 7. As we just talked about in the lecture, we need to take a look at the cash flows and schedule them out. We'll then discount the cash flows back into today's dollars using the appropriate present value table. And then we'll compare the present value of those net cash flows to the $300,000 cost that we were required to put into purchasing this investment. If the net present value is higher than 0, it would be considered earning above our discount rate of 7%. If we get a negative net present value, we would turn the investment down because it's not generating our desired cap rate of 7%. So let's schedule out the cash flows, and then we can apply the appropriate present value tables. So to schedule out the cash flows, let's take a look at the amounts coming in over the life of the asset. The first thing we notice is that the asset costs $300,000. That's in today's dollars, so there is no need to present value that back. In fact, we will be comparing the present value of the net cash flows to that $300,000 at the end here to decide whether this is a good investment or not. So now that we know that there's no need to present value back the cost because that money would be spent today, let's move on to the cash inflows. Earlier in the problem, specifically number 1, when they asked us to calculate the net cash flow for each year, we mentioned that that meant $105,000 would be coming in each year of the asset's life. Because that amount is occurring at the same time in the same amount each year, we can use the annuity table where n equals 4 years, which is the life of the asset, and the interest rate is equal to 7%. The annuity table is really a shortcut of scheduling out individually each one of those 4 years. The annuity table grabs those factors and lumps them all together, and so it creates a bit of a shortcut for us to use when we have an amount that's coming in at the same time, at the same point, in the same amount each year. In addition to that 105,000 that's coming in each and every year, we also have a one-time salvage value that's coming back to us at the end of the asset's life. Remember, the definition of a salvage value is a judgment estimate on what that asset could be sold for when we're done with it at the end of the asset's useful life. As given in the problem, this was 20,000. Since this is coming back only to us one time at the end of the asset's life, we'll have no choice but to use the regular present value table where n equals 4 years. That means it's coming back in the 4th year. And I, or the interest rate, is 7% as given to us by our author. Go get the present value tables out. Look up each one of those two items, the 105,000 in the annuity table and the 20,000 in the regular present value table. We'll grab the factors, write them down, and then we'll do the math together. Pause the video and go see if you can find the correct factor before proceeding on. Here's the annuity table. The annuity table would be used for the net cash flow that was coming in each of the 4 years. The 105,000 was coming in year 1, year 2, year 3, and year 4. So the factor here of 7% for 4 years represents all those individual factors for each of those individual 4 years added up. In that way, this allows us to take a shortcut approach. Here's the regular present value table. This would be used for the salvage value that was coming back one time in the 4th year. Go to the 7% column, go down to period 4, and there you will see the factor to be used for the salvage value. Write it down. Okay, we've inserted the factors that we found in the two present value tables. So let's go ahead and do the math. We took that $105,000 annuity that was coming in each year, and we multiplied it by the present value of an annuity table where n equals 4. That is based on the life of the equipment, and I, or interest, is 7%. That's also called the discount rate, hurdle rate, cap rate, all kinds of names for it. 355,656 is the value of that 105,000 coming in once a year, each year for 4 years. That is the value of that in today's dollars. And then that salvage value that was only coming in one time at the end of the life gave us the present value factor that you see on your screen. When we multiplied that out, the present value of 20,000 to be received 4 years from now in today's dollars is worth 15,258. That's the total present value of the cost inflows. Let me go ahead and add those two up. And what we would do is we would compare that to the cost of the investment, which we said is already in today's dollars. That cost was $300,000. I'm going to put that as a minus amount just to reinforce that that is cash going out. And when we do that, we get a net present value of, let me get some equal sign in there to show you that this is the end of the problem. And when I do that, actually I can do just a net sum, or I can add them up. because one amount is entered as a minus. We get 70,914. Because that is above 0, we know that we are getting back our 7%. The downfall to this method, or the negative disadvantage, is that although we know we're getting above 7%, this method does not allow you to quantify the exact rate. Shortly, you'll learn that the internal rate of return can tag that rate exactly where it sits. That's the net present value method. We'll practice it some more, but this wraps up the lecture from last time by showing you one way of calculating the value of an investment using discounted cash flows. On to the next. In this exercise, we will compute the cash payback period and then compute the net present value. And as you'll notice, these are unequal cash flows. That means we cannot use the shortcut for the payback method. So on the screen, you'll see the cash flows for both projects. We'll have to add up the cash flows until we recoup the cost. The cost for project 1 is $60,000. So we're going to accumulate this cash until we get back to $60,000. And as you can see pretty easily, the first one, we recoup the cash right at the 2-year mark. So the cash payback on project 1 is 2 years. The second project also costs $60,000. So we'll add up its cash until we get back to the $60,000. After 1 year, it's $35,000. After 2 years, it's $55,000. We see that we will hit payback somewhere between years 2 and 3. That would not be an adequate answer. So right now, we know that it is 2 years plus, and here's where the little miniature calculation comes in. Our cost was $60,000. After year 2, we're $5,000 away. So I'll put $5,000 and I will divide by the next year's cash flows of $20,000. And so this answer would be 2.25 years. So if we had to choose one, we only had enough resources for one investment, the shorter the better. So we would choose project 1 here. Letter B asks us to compute the net present value for each project. So we've scheduled out the cash flows, and the methodology we would use on this is we need to go to our regular present value tables. Okay, we can't use the annuity because it's not the same amounts each year. So we're forced to stick with the regular present value table, go look up those factors, write them down, and we'll come back and finish this exercise. From the present value table, we'll see that the present value for the first year factor is 0.9091. The present value table at 10% for 2 years is 0.8264, and the present value for the third year is 0.7513. Let me make sure we have adequate decimal places on here. Looks like our present table factor table is at least 4 decimals, so let me go ahead and put those on. We'll copy those over because the factors aren't changing. We'll go ahead and do the math and come back and compare our answers. As you can see, after we extend out the factors to come up with the present value of the cash flows and then compare it to the asset's cost, only one of the investments has a positive net present value, and so only project 2 would be considered viable, and meeting the 10% rate of return. Let's move on to the next one. Let's do another net present value problem, but this time we're going to take it one step further and bring into play the profitability index. In this problem, you'll notice that we have two projects, but that the costs are different. Project X1 costs $80,000 and Project X2 costs substantially more at $120,000. When projects have different costs, they are not automatically comparable. In other words, we can't just look at the net present value and take the higher of the two. Instead, we need to index them. When comparing projects of similar investment and risk levels, we can rank them on net present value. But if the initial costs differ across projects, we need a different method. One way to make these automatically comparable is to compute the profitability index. The profitability index is the present value of the net cash flows on top divided by the initial investment. Once we compute this index, we can automatically rank projects and invest in the project that has the highest profitability index. Let's take a look and see how this works. Using the regular present value tables for a 3-year investment at 4%, we would drop in the factors as shown. Then we would do the math extension where we multiply the cash flows by the present value factor, add them up, copy the formula down, add them up, and then compare that to the asset's cost. Once I get that result, then I'm ready to move on to the next step. So let me go ahead and copy these formulas over. Let me do the same thing for the other investment. After summing up the extended cash flow numbers, adding them up, and comparing it to the cost, we have the net present value of our two investments. Because the costs are different, these are not automatically comparable. Some may make the mistake of choosing the one with the highest net present value, and that may result in a wrong mistake. Instead, what we want to do is we want to index them. And as shown previously, the formula for indexing is to take the present value of the net cash flow and divide by the cost. When we do that, we'll have an automatic way of ranking competing investments. Project X1, when divided as shown, has a ranking of 1.38, and the second investment has a ranking of 1.24. Once you rank them, you can automatically go from the highest to lowest if funds are limited. And in this case, we would choose Project X1 that has the highest ranking. On to the next one. This next exercise is very similar to the previous one. However, this time they changed the cap rate or the discount rate to 12%. Since we have just worked with the same figures in the previous exercise, go ahead and fill in the problem or work out the problem from scratch, compute the net present value, and the Profitability Index, and we'll go over the answer in a few moments. Go find the correct present value table and let's fill in the factor. Use the regular present value table where I equals 12%. Let's review the results. The first project had a net present value of $13,687, indicating it is earning above the cap rate of 12%. The second project earned a net present value of $1,906. Notice, because the costs are different, we can't rely on those bottom line numbers by themselves. Instead, we needed to index them. The indexes are shown on the right. The higher net present value index would tell us that if the company could only choose one project, it would choose X1. On to the next. Another way to evaluate investments is to use the internal rate of return, which computes the exact discount rate that yields a net present value of 0. Your text will show you how to compute and back into the internal rate of return, as it demonstrates how to compute a present value factor. However, Excel has a built-in feature that can easily and quickly calculate the exact net present value. Let's give it a shot. The built-in internal rate of return function within Excel is super easy to use. Make sure that you put the cost in negative values at the top, and then list the net cash inflows sequentially underneath. All you do is type in equals IRR, which is a built-in function in Excel, open the parentheses and highlight from the top to the bottom and press enter. Format this as a percentage so it shows up adequately enough, and do the same thing with the next. We knew that X1 was earning more than X2 based on the previous two exercises, but we couldn't quantify the exact rate of return. Excel, however, at the touch of a button, shows you that X1 is clearly the superior project because it is earning almost 7% more than X2. It's a super easy function to learn. I would add that to your toolbox. Let's move on to the next one. Here's an exercise where they ask us to compute the net present value of an annuity. Remember that an annuity assumes that the cash flows are equal and coming in on a consistent basis over the life of the asset. This exercise refers to a previous exercise, 24-1, that we covered in the first day of class. So for ease of understanding, I just copied that information over, from day one. On day one, we computed the cash flows needed to compute the net present value. We found when we did that exercise that cash flows for the first project came in at $28,000 a year, and that cash flows for the second project came out at $25,000 a year. That'll be the information that we use to compute the net present value. So moving over here, you can see that I've copied the cash flows over from that previous exercise. What we needed to do was look up the factor of an annuity. Make sure you look at the annuity table. This represents a shortcut for us. Rather than scheduling out each year of the asset's life, for project 1, we would have 7 years where we would have to individually schedule out the cash flows. Rather than do that, the annuity table provides a shortcut by adding up each of the factors for those 7 years on the first one and 5 years on the second one. So pull up a present value annuity table, find the factor for project 1 where I equals 10% and N equals 7, since this first project had a 7-year life, you should see the factor in yellow. And then while we're on the table, on the second project, look up the present value of an annuity factor where I equals 10% and N equals 5 years, and you'll see the factor here. Let's multiply them out. And then compare them to the cost. If we have a positive number, then the investment is earning above the required minimum rate of return of 10%. In this case, the cost of that first investment was $140,000, and the cost of the second investment was $90,000. Let's go ahead and compute the net present value. And as you see on this first one, it gives you a negative net present value. That means that this investment is not earning the required 10% cap rate or discount rate. On the other hand, the second investment is earning a positive net present value. Unfortunately, all we can tell you about this second investment is that it is earning above the 10% cap rate. One of the disadvantages of the net present value method is that it doesn't quantify exactly what rate that investment is earning. On to the next one. The internal rate of return method has an advantage over the net present value in that it can return an exact rate of return. In this example, the company is considering an investment costing $214,170 that results in net cash flows annually for 11 years. What is the internal rate of return of this investment? Well, we can go down to the bottom here, and we can use Excel's built-in IRR that stands for internal rate of return, highlight from the top to the bottom, where the top represents the money expended today, and the rest of the numbers that follow represent the cash flows brought in sequential years. When I press the enter button, the rate of return is, let me put a few decimal places on it, exactly 8%. The problem goes on to say the hurdle rate is 9.5%. That is their cost of capital. That's the cost that they want to see their investment earn. So since our investment is earning only 8%, and the company desires a rate of 9.5%, we would turn this project down because it is not in line with our expectations. On to the last one. This is a great problem that summarizes 3 out of the 4 concepts that we've discussed in the chapter. I would highly recommend it as a study question for your exam. It says Lopez Company can invest in one of 2 alternative projects. The first one requires a $240,000 investment, and the second one requires a $240,000 initial investment for new machinery with a 3-year life and no salvage value. Okay, let's read that carefully. They have equal costs of $240,000. The first investment will last 4 years. The second investment will last 3 years. Neither one of them have a salvage value. They give us the net incomes, look carefully at the box, and then they ask us to do several things. Requirement 1 says compute the annual cash flows. So we started with the net income figures shown in the chart, and then we added back the depreciation because depreciation is a non-cash outflow. We added those 2 up and we got the cash flows for each project. Number 2 asks for the cash payback. It's imperative that we learn which method uses which input. The cash payback, by its very name, looks at cash. So we have equal annual cash flow, so we can use the shortcut method. So we're going to take our cash investment on the top and divide by the equal annual flows on the bottom. So I would encourage you highly to write down the formulas each and every time that you compute one of these 4 methods that we're talking about in this chapter. The cash investment was $240,000 for each one, and the equal annual cash flows were computed above. So let me put those in there. When we do the cash payback method, we are looking for whichever method, whichever project returns our cash in the fastest manner. That way it can be used for something else. In the case of the first one, the cash payback is just shy of 2 years. On the second one, it's even shorter. The cash comes back in 1.5 years. Requirement 3 asks you for the accounting rate of return. The accounting rate of return is the only method out of the 4 that we've learned that focuses on GAAP net income. So rather than cash this time, we want to use the net income that you see in the box. So you see the formula that I've written down previously. The GAAP net income for the first one is $64,000. The GAAP net income for the second one is $90,000. And the cost would be the $240,000. There was no salvage value, and that would be divided by 2. The costs are the same for each one of these 2 investments. I remember reading that at the top, so let me copy over this cost here. And because this is an accounting rate of return, anytime you're asked for a rate, it's going to be formatted as a percentage. So let me calculate this first, and then I'll format that properly in the way it should be formatted, which is a percentage. Sorry, my cursor is giving me a little bit of difficulty today. So when I pop that in, if we're looking at a GAAP perspective, these are both very high rates of return. One is earning 53%, one is earning 75% as far as GAAP goes. Finally, we'll be asked to compute each project's net present value, which means we'll go back to the cash flows. Requirement number 4 asked us to compute the net present value using the factors from the annuity table, where I equals 9% and N equals 4 on the first investment because it was expected to last 4 years, and N equals 3 on the second investment, which was only expected to last 3 years. We use these factors. We multiply the 2, the factor times the annuity or the annual cash flow that's coming in, and we compare it to the cost of the investment. The cost of the investment was $240,000. So the first investment has a net present value well above 0. And when we do the same thing on the second investment, we see that it has an even higher net present value. Let me fix that cost. Because the costs are the same, they are automatically comparable, which means we can look at the net present value directly and not have to worry about indexing them. If we did have to index them, we would take the present value of the cash flows divided by the cost. In this case, we'll go ahead, even though the author didn't tell us we had to do that, we see that investment Z has the highest profitability index. So let's take a look at the results of these various methods and see if we can pick the better of the two alternatives. Scrolling back up to the top, we saw that number 1 had the higher annual cash flows. Project Z had the highest annual cash flows. In addition, it had the shortest cash payback period. It also had the highest accounting rate of return. And finally, it had the highest net present value as well as the highest profitability index. So Project Z would be the more favorable project. Let's come back and do a wrap-up of the chapter.
As a wrap-up to this very important chapter, I thought we would cover the reasons why this chapter is important. Capital budgeting decisions require careful analysis because they are usually the most difficult and risky decisions that managers make. Specifically, they are risky because the outcome is uncertain. There's usually very large amounts of money that can be involved, including financing costs. The investment involves a long-term commitment, and the decision could be difficult or even impossible to reverse, no matter how poor it may turn out to be. Risk is especially high for investments in technology due to innovations and uncertainty. We started by talking about two non-present value methods. The first method was called the payback period, and the payback period is the amount of time expected to recover the initial investment amount. The payback period is a method used to evaluate investments decisions by measuring the expected amount of time it takes to recover your cost. Managers prefer assets with shorter payback periods to reduce the risk of an unprofitable investment over the long run. The formula is on the screen. Remember, the shorter the better. The accounting rate of return was the second non-time value of money method. We said the accounting rate of return is an investment's annual net income divided by the average amount invested in it. This was the only method that took into consideration the GAAP net income. In addition, the average investment on the bottom was computed as the cost plus the salvage value divided by 2. We then discussed the concept of present value, and we talked about how important that is in making long-term investment decisions. The net present value analysis applies these time value of money concepts to future cash inflows and outflows so that management can evaluate a project's desirability. We discounted the future cash flows from the investment using the given required rate of return. This required rate of return is also known as the hurdle rate, the discount rate, the cost of capital, and a bunch of other names which are all synonymous. In general, it's an average of the rate the company must pay to its lenders and investors. After we discounted back the cash flows, we compared it to the cost, and if we got a positive number above 0, it was considered a good investment. If we wound up with a negative net present value, then we would reject the investment. When comparing projects of similar initial investment amounts and risk levels, we could automatically rank them based on the net present value. However, if the initial investments differed across projects, we needed a different method. One way to compare the projects, especially when a company cannot fund all the positive net present value projects, is to use a profitability index. We computed this as the present value of the net cash flows divided by the cost. Computing the profitability index has the advantage of using an automatic rating system when we have competing investments. The fourth method that we discussed was the internal rate of return. This also is a time value of money concept. We learned that one way to evaluate capital investments was to compute the internal rate of return, which equals the discount rate that yields a net present value of 0 for a specific investment. Stated another way, if we compute the total present value of a project's net cash flows using the internal rate of return as the discount rate, and then subtract the initial investment from the total present value, we would get a 0 net present value. We also learned that mathematically it involves calculus and interpolation techniques. However, thank goodness for Excel, which allowed us to very quickly compute any project's internal rate of return by scheduling out the cost as a negative number on the first line and then listing the cash flows in the order in which they occurred. There's a lot going on in this chapter. Make sure that you feel comfortable with the advantages and disadvantages of each method. There's a lot of formulas and it will take extra practice to master them. This is Professor Johnson for the very last time, signing out.